Well, after an exhausting and mammoth meeting in Brussels, Eurozone finance ministers have finally reached agreement on a second bailout package for Greece. The deal means the Greek government will receive another rescue fund worth €130 billion to prevent its economy from defaulting on debts next month. But there are strict conditions attached. Here are some of the key points that have emerged so far. Well, ministers were discussing a Greek debt target of 121% of GDP, that's gross domestic product, by 2020. It's a little above the target set originally by negotiators. Now, to help Athens reach that target, private bondholders have agreed to accept a bigger loss on their investments of 53.5%, or perhaps even more. This debt exchange is going to help reduce Greece's debt by about €100 billion. The European Central Bank will pass up profits it's made from buying Greek bonds over the past 2 years under its emergency bond buying programme. But will it work? Martin Koehring is an economist with the Economist's Intelligence Unit, and he joins us now. Well, Martin, let's start with that. It's a massive proposal. Is it enough to save the patient?
Well, that's a good question, but in our opinion, it's definitely not enough. Because if you look at the target, 120% of GDP, that's twice as much as even the European Commission has in its own target for Eurozone countries, which is 60% of GDP. So 120% of GDP is clearly not sustainable, even if Greece implements the fiscal austerity measures, which we think they will not be able to do so, because they have already done a lot, and there's social unrest in the country. There are a lot of political uncertainties. There's a general election in April, and it's far from clear that all these austerity measures will actually be implemented. And even if Greece implements all of these measures, 120% of GDP is clearly not sustainable. Debt interest payments will be too high. It will be very difficult for Greece to ever return to economic growth. So it's very likely that there will be more bailouts in the future. It's very likely there will be more debt restructuring, more than the 107 billion that private bondholders are losing already. So there will have to be some public-wide write-down as well, including from the European Central Bank and government. So it's clearly not enough. 120% of GDP is not sustainable.
Yeah, because very interesting vortex that you suggest here, Martin, which is they're loaded with debt, and in order to get out of that, the European Central Bank will have to give them more debt eventually. That's just not going to work, is it? Yes,
exactly. I mean, it's a self-defeating logic, really. I mean, they're expecting Greece to cut its public spending tremendously over the next couple of years, and at the same time they're expecting Greece to grow. It's very interesting that during the latest negotiations by Eurozone leaders, some documents were leaked from the European Commission that basically show that even under the most optimistic growth outlook for Greece, which would assume that by 2013 they wouldn't grow at all, in 2014 they would start to grow, even the most optimistic growth outlook, even then Greece would still need about 50 billion in additional bailout money. So even the European Commission knows that these targets are not very realistic, so there has to be more measures. So we think that the whole deal is basically intended to save some time, to actually ring fence and provide a firewall for other countries such as Italy and Spain, which are basically solvent but face liquidity problems in the market. So this is not really about saving Greece or solving the Greek debt crisis. It's about buying time again.
Quick thought, Martin, where are we going to be in 6 months' time?
Well, we're going to be at the negotiation table, at least in Brussels. They will sit around and negotiate whether this is really sustainable. I mean, it's really a question of what governments can do, and potentially they would have to really write down Greek debt to about 60 to 80% of GDP. That's more realistic. And unless they do that, Greece will continue to face this self-defeating logic of fiscal austerity and lack of growth.
OK. Martin Koehring from the Economist Intelligence Unit, thank you very much.